Hi everyone, Kevin here. Today I'm joined for the quarterly update by Crista Caughlin, lead portfolio manager of our Canadian bond strategy, and Jeff Moe, the lead portfolio manager of our US midcap strategy. This has felt like an extremely long start to the year. We've had nonstop headlines, tons of news to digest, gyrating markets, lots of uncertainty. And of course, at the start of Q2, we had the so-called Liberation Day, which was the imposition of tariffs by the US, retaliatory actions by other countries, and the major fallout from these actions across rates, credits, and equity markets. Nevertheless, we are going to start with a little recap on Q1. Equity returns were, at least in international markets, were quite strong, particularly in EFI as well as even emerging markets. Canada was modestly positive overall, though that was largely pulled into the positive territory by the materials, particularly gold miners. The notable news, or particularly noteworthy news, was the US generally, as well as tech particularly, took a breather after leading the way for a long time. Core fixed income also saw positive returns as yields generally fell in most major markets. Now, of course, a lot of this in some ways is old news. Given the major volatility we've seen since the end of the quarter, we're going to cover both periods, both Q1 and what's happened in the last week and a half or so throughout this episode. So let's start with Crista. You can just give us a recap on what drove fixed income returns in the quarter, as well as what's been notable that's happened since the end of the quarter.
So volatility has picked up since quarter end. However, it really was a theme that has existed since the beginning of the year. You know, last quarter, we talked a lot about the unknowns around the new administration, which direction they would take, which policy levers would they pull first. What we learned over the quarter was that global trade really was going to be at the forefront. The first threat of tariffs happened in early February, February 1st, I believe. We also learned about DOGE, which was announced at the end of January. And so we started hearing about government employment layoffs. Now, in addition to the unknowns around the administration, we also saw weaker data over the quarter. So ISM is below 50 again. Retail sales are a bit softer. The unemployment rate has ticked modestly higher. In the US, Q1 GDP growth is now tracking closer to 0.5% or 50 basis points relative to the 2.5% we saw at the end of last year. And so we have a lot of unknowns around fiscal policies in the US with the backdrop of slowing or less supportive growth. And so as you mentioned, Kevin, you know, with that as the backdrop, we did see yields fall over the quarter. 10 years declined around 20 basis points, ending at 3%. In the US, 10 years declined around 35 basis points, ending at around 420. We also started seeing spreads leaking wider. Investment grade spreads were about 10 basis points wider, and high yield spreads were about 25 basis points wider. So we saw a small widening of spreads on the quarter, but keep in mind, still very low by historical standards. So that was quarter end. Obviously, since quarter end, we've had Liberation Day, sweeping tariffs, retaliatory tariffs, a pause on tariffs, and volatility has really picked up. We've seen some pretty material swings in both credit markets and rates markets. Since April 1st, the Canadian 10-year has traded between 280 and 325, so a 45 basis point swing over the last few days. In terms of credit markets, Canadian credit was 15 to 20 basis points wider at one point, has tightened back a little since then. High yield markets traded as much as 100 basis points wider, is now sitting closer to 50 or 60 basis points wider. And so overall, since the beginning of the year, including the latest round of, including the last week and sort of this latest bout of volatility, we have yields that are modestly lower, call it flat year to date, and credit spreads are wider.
Excellent. Jeff, same question for you. If you could just give us a recap on the equity markets through the end of the quarter, as well as an update on Q2.
Sure, Kevin. So it's kind of bifurcated a little bit, where Europe did quite well and the US took a bit of a breather. Certainly G stocks led on the downside, particular weakness in some of the Mag 7 constituents. The European kind of stocks being strong through Q1, I think initially was a bit of a surprise for some people because there wasn't a lot of kind of fundamental strength there. But I think just the relative valuations, depending on the markets you looked at on a relative basis, just like a P basis to the US, you saw anywhere from like a 25 to even a 40 or 50% discount in some European markets. So some of that, some of the quarter as indices kind of were flat to slightly falling, which was generally up. And I think the big news for Europe was a rearmament. So as became clear that the new Trump administration was maybe increasingly serious, kind of pulling the US security umbrella from Europe and reducing force in Europe, I think a big turning point when the US actually sided with Russia at in condemning the invasion on a particular resolution. And so that was a call for many European leaders. And that led to Germany in particular pushing and eventually succeeding to exclude defense spending borrowing from their deficit calculations because they have a law saying they can only go past a certain amount in deficit spending per year in the government budget. So that really drove particularly defense stocks, but I think in general more optimism for Europe that a lot of this incremental spending announced by Germany, and it wasn't just Germany, there are other countries that had also increased spending, that most of that would flow to domestic European industries. So there is a view that there could be revival in the industrial base in Europe. So that certainly was quite positive for European equities, at least to the end of Q1, obviously with the tariff announcement in early Q2. That certainly caused a bit of a pal. Here in Canada, things were a little bit tougher. There was uncertainty, certainly with tariffs. As Crista mentioned, Canada and Mexico were the kind of the first countries to be on the trade front, on the tariff front. That we also had government uncertainty at the same time, given that it was a little bit unclear who was going to be prime minister. We now know Mark Carney is prime minister, but there is still an ongoing election, which is not the best time to have an election when there is a trade war with your largest trading partner. So Canadian equities, excluding gold, generally as I think a lot of people were just worried. And I think the Bank of Canada has taken a much more dovish stance with that backdrop compared to the US Federal Reserve. So flipping over to the last week and a half, I won't necessarily repeat everything that happened. I think most market participants are probably aware of the large impact on equity markets that were caused by the so-called reciprocal tariffs announced by the Trump administration. It was just a situation where this is largely psychology driven. The psychology that kind of came out was, I think there was expectation after President Trump threatened tariffs on Canada and Mexico, and then for the most part pulled back and at least allowed goods that were part of the free trade agreement, USMCA, to be exempt from tariffs. And so that was sort of the backdrop that investors had in mind going into April 2nd when Donald Trump had signaled to put on tariffs to more countries globally. But I think the worst case scenario was President Trump was going to impose tariffs on every single country in the world at pretty high rates until April 9th when most of those tariffs, except on China, were paused. And so equity markets have gyrated a lot. I think the VIX, which is index that measures volatility, spiked to 50, up from I think 20. So that certainly caused a lot of angst for investors. But ultimately, after the pause announced on April 9th and the subsequent market rally, equities have actually not moved all that much in Q2, I think in the kind of mid-single digit range. But volatility is very high now as the uncertainty created by the on-again, off-again tariffs really make it hard for business leaders to manage. And in fact, on that point, when we talk to companies, even prior to April 2nd, but certainly after April 2nd, the feedback we're getting from the CEOs that we invest in about investing in, just a lot of comment, not necessarily on the economy being incredibly weak, but just the anticipation of uncertainty causing a lot of businesses to pause investments or hiring for new projects and that thing. And if confidence stays weak for a long period of time, that could start to filter into the real economy.
So we've talked a little bit about what's happened so far with tariffs. So I guess, Crista, if you can comment a little bit on how you're thinking about the various scenarios of how this could play out going forward. We've seen a lot of activity already. Probably very difficult to predict what will happen going forward, but how are you thinking through different scenarios?
Yeah, so previously we didn't know what tools the US was going to implement first. Was he going to push on sort of the growth positive policies such as deregulation and tax cuts, or was he going to push on the ones that maybe have more negative implications, at least for short-term growth, such as tariffs, trade policies, and DOGE? We know now that he's pushing through the harder stuff sooner. And not only is he executing on difficult policies, at least from a short-term economic standpoint, they're more aggressive than we would have expected. There's still a lot of unknowns. 1 minute there's tariffs, the next minute they're delayed. But what we try and do is sift through the noise by taking a step back and really looking at what the implications of trade policy are on growth and on inflation. Now, the direct impact from tariffs are well known. It's a negative implication for growth, at least in the short term. And tariffs obviously result in higher prices or higher inflation. But there's also indirect effects from tariffs. And a lot of those indirect effects are around the uncertainty that a trade war brings. Jeff sort of touched on a lot of these, but that would include things like reduced business spending, reduced business hiring, reduced consumer spending. If you're an auto worker in Ontario, or if you're in the forestry industry in BC, it's not unreasonable to be worried about your job security, which likely reduces your desire to spend currently. And then the last one, one of the sort of more likely unintended consequences of all of this is really just a tightening of financial conditions. And so that's going to have implications on businesses, consumers, really just growth as access to capital decreases and the cost of capital increases. And so it is a positive thing that tariffs have been delayed, but the negative growth impacts or implications just due to the uncertainty alone still exist. And so regardless of whether or not tariffs are going to be 10%, 25%, or potentially delayed inevitably, I think the growth picture, all else equal, has gotten worse given the uncertainty. And so, if uncertainty continues for an extended period of time, or if large tariffs do come into effect, the probability of a material growth slowdown has increased, or at least the probability of a recession starts increasing.
So that's more of a macro top-down perspective, or lens of thinking through some of these tariff risks and the knock-on effects of growth and inflation. Jeff, on the equity side of the ledger, how are you and the rest of the equity team sort of taking these tariff shocks, potential future actions into account when you're doing your bottom-up sort of fundamental company analysis? Are you already starting to see some of those impacts of tariffs flow through to company earnings, or is that more in the next coming weeks and months?
Yeah, I'll answer your second question first. We aren't seeing the impacts of tariffs flow through yet, partially because Q1 earnings haven't been reported yet. So all we have is data from December 31st when Joe Biden was still president. However, there could be small impacts on Q1 earnings as some of the uncertainty, especially for countries that may be traded with Canada or Mexico, there might already be some impacts. And then Q2 obviously would be the big one, depending on with the reciprocal tariffs. But we're still, as I sort of alluded to in my last comments, we are seeing it from a kind of a business environment or a confidence to invest standpoint. And the equity markets anticipate this. So some companies in the auto supply chain, for example, have been kind of negatively affected from a sentiment standpoint. In some cases, on both sides of the Canadian-US border, hearing commentary of certain plants shutting down. Stellantis plant kind of took a furlough their employees for at least a couple of weeks. And so these things will kind of start to filter through. The other piece, and Crista touched on this, is you have uncertainty in your job security, you will not really want to spend as much. And it's not just job security. I mean, as I said, that have started to get furloughed. I was also reading maybe a month ago about a small Montreal that made furniture. And they actually ended up laying off a bunch of workers because just even the uncertainty alone of whether or not companies in the US could order Canadian furniture and get it across the border tariff-free, caused a drastic drop in orders for them, where they had to shrink their business. But probably the big one actually would be dealing with the US civil service, with a pretty kind of indiscriminate type of kind of set of layoffs, largely maybe driven by the Department of Government Efficiency. And I think it's not even that many federal workers have been let go. It's the feeling amongst the civil service that the new administration is not supportive of what they do, and that anyone at any time could get fired. And so I think from that standpoint, it's causing a lot of those federal workers to be a lot more cautious in their spending. And I mean, that's a pretty large workforce across the country. And they have friends, they talk to their friends. And so you start to get, and we're starting to see it in kind of consumer confidence surveys and some of the leading indicators, that there is a dampening effect on consumer spending. And this is before we talk about tariffs. And certainly if tariffs get implemented, I was just reading in the Wall Street Journal this morning about Walmart and how they are thinking about navigating the now 125% tariffs on Chinese goods, because those tariffs have not been paused. So even on that standpoint, a lot of more basic goods that are manufactured in China and sold in retailers like Walmart will be going up in price. And that will affect the consumer's ability to buy goods in a scenario, or in a situation where some people have already lost their jobs and more people are feeling uncertain about their jobs. And then the other thing I guess I haven't talked about very much is the kind of deportation push. And so there are, the estimates out there anywhere from 10, 15, 20 million people who are undocumented living in the United States. I mean, that's upward of 5% of the population. And because of the worries of being deported, because of the worries of raids on workplaces and factories, some of these workers aren't showing up at work. Well, they're not getting paid anymore. And so it's all kind of small effects that in aggregate add up to a softening in the consumer picture. And I think tariffs are a big part of causing that.
We focus on the bottom up when we're building portfolios, so the quality of the businesses themselves and the valuation they're trading at. But I'm just curious if, given the kind of volatility and uncertainty we're seeing, does this for you change how you think about portfolio construction? Do you lean or adjust a little bit more or less in some particular way? Or is it kind of, you continue to sort of executing on the process? Is there adjustments that you would make on the portfolio construction side?
Yeah, so by and large, no. I'd say that, and those who listen to our podcast regularly be familiar with this analogy, is that the time to kind of fix your ship is in dry dock, when things are sunny and you can kind of carefully, methodically build out your ship. When you're sailing through the storm, it's much more dangerous to go and fix your ship, because you might climb above deck and get hit by a wave and you end up having more damage done to you. The key point, I think many of our listeners do understand, but I'll just reiterate again, is that we think of ourselves as active bottom-up managers. So what does that mean? That means we narrow the scope of the prediction that we are making on behalf of clients. So our job as bottom-up managers is to predict the future. So we predict how strong the competitive advantages of the companies we buy will be and are. But then for things like how high will tariffs go, how long, which countries, are questions like, will interest rates be higher or lower in 6 months, 12 months, 18 months? Those questions undoubtedly impact equity market returns. But the way we think about it from a portfolio construction standpoint is we need to be passive on those questions. And when I say passive, what I mean is we will have inherent contradictions in the portfolio. So if I could talk, say, my own book for a second, in US midcaps, we own a company called FTI Consulting, which is the largest bankruptcy consultancy in the US. Their competitive advantage is a brand. So they are the most well-known, and they tend to win the mandate to work out the biggest bankruptcies, such as Hertz Global in 2020, rental car company went into protection. On the flip side, we do own a company called Shark Ninja, which is a small household appliances company. Both of these companies are wealth creating. They have strong competitive advantages in our opinion. But as you can imagine, when tariffs are maybe higher, FTI may do better because there could be more bankruptcies happening. On the flip side, if all of this goes away and the economy looks very sunny again, Shark Ninja will do relatively better. But the whole point is that we have these inherent contradictions throughout all of our portfolios so that we aren't necessarily shifting one way or the other. That being said, as bottom-up managers, we will make certain shifts. And the way we do that is when we are aware of a new business environment. So in April 2nd, there could be a new business environment for importers and exporters and those that rely on goods moving across borders. Then we will go into our discounted cash flow models and we will adjust our assumptions. Or in some cases, we would just adjust the range of our assumptions. Those of you who know about our discounted cash flow model will hear about our Monte Carlo simulation. So what that means on a practical standpoint is we might say the growth rate for 2025 for companies, we used to say had a standard deviation of say 2%.
Appreciate the color there, Jeff. Crista, let's move back to you. It's going to be it must be a difficult job right now to be a central banker. The Fed was on hold this quarter after three straight cuts to end 2024. The Bank of Canada, meanwhile, continued cutting. It feels, certainly it's a very uncertain environment. It feels like as a central banker, this would be the time where you really have to earn your keep because I think you can make arguments on both sides. What's your sort of read on that?
Yeah, I mean, central banks are in a really difficult spot right now, which is why I think they're in somewhat of a wait and see mode. The Bank of Canada did cut this quarter. The last cut was in March. The rationale for the cuts this quarter have sort of been similar to what we've seen all cycle, which is the starting place for growth was weaker and inflation was lower in Canada. Having said that, I do think the March cut was a bit of an insurance cut as tariffs were ramping up. And so the Bank of Canada really wanted to make sure that Canada was in the best place possible going into any type of trade war. Now, going forward, whether it's the Fed or the Bank of Canada, as I mentioned, I do think they're in a bit of a wait and see mode. And to be honest, they're in the same place the rest of us are. They don't actually know what the impact of the tariffs will be because they don't know the size of the tariffs. They don't know what countries are going to be put on. They don't know the duration of them. And so because of that, they can't really offer any type of forward guidance with respect to what we should expect policy to be in the coming months. Now, in spite of that sort of lack of forward guidance, they have been very transparent with respect to how they could act as we gain more information around the tariffs and what they're looking for. And I think the Bank of Canada really kind of summed it up best. They talked about the fact that, central banks can't overcome the effects of a trade war. If we do get a full-blown trade war and it does cause a recession, it's unlikely the central bank will be able to do anything to avoid that recession. They will, however, do everything in their power to help the economy adjust. But keep in mind, what they can do will be limited by their need to control inflation. And so on the inflation front, what are they watching? Well, they're really watching for that potential long-term structural impact on prices. If we do get tariffs, inflation is going to increase. That will be a one-time increase due to the tariff. And that's something they're less likely to really respond to with any kind of force. But what they will be watching for is that one-time increase on tariffs going to place additional upward pressure on prices just by a rising cost, adjustments to supply chains, shifting to substitution products. And so they're going to be assessing the potential long-term structural impact on tariffs we may get if we do see lower demand.
And then what changes did the asset mix committee make this quarter, if any? And then I guess even more importantly, how is the committee thinking through all of the current volatility right now?
I think what's the saying is be boring. I think don't overreact, don't get caught up in the noise. Stephen, who's the lead manager of the balance strategies, I think had the quote of the week. It was no hero trades. And so we've really held a neutral position in equities throughout the quarter. And with volatility and risks increasing, I would expect us to remain neutral for the time being. Within equities, we did make a small tweak. We shifted from US equities towards international, really to increase our European exposure. And Jeff talked a lot about sort of what's been happening in Europe and some of the positive things that are happening in Europe, particularly increased fiscal policy, increased defense spending. And so we think some of these things will obviously benefit Europe and create a potential structural tailwind for them. Overall, we continue to be overweight international. We have a modest overweight to the US. We did talk about this quarter was adding global credit. We've become increasingly confident in the strategy, and we really do believe it offers a really attractive risk reward relative to other positions within the balanced strategy. And so I would expect us to add global credit in the coming months, and it's something you'll likely hear more on in the future.
Jeff, last question for you before we wrap up. This type of market turbulence is often fear-inducing, understandably so, but at the same time, it does have the potential to present opportunities. You kind of alluded to that a little bit already. In times like this, is there anything, whether it be process-oriented, behavioral, et cetera, things that the team relies on to help ensure that we're trying to make decisions in this type of environment?
I like how you asked if it was process-oriented or behavioral, because that's exactly what I think it is. We have a process at Moeller to manage our behavioral psychology biases. As the famous behavioral psychologist Daniel Kahneman wrote in his seminal book, Thinking Fast, Thinking Slow, we sort of have two brains in our single human brain, sort of that kind of instinctual reactive brain, a lower order brain that is whenever threats come out, like market drop, that we want to go into fight or flight mode. We want to make hero trades to use an asset mix, Stephen Mischer comment. But then we also have our higher order brain, our thinking slow brain. And this brain is highly analytical. It slows down and thinks things through. One really effective way to engage your thinking slow brain is to have process. And so when we see tariffs, we don't, and say a stock that we like drops 5 or 10%, or even more in some cases, we don't just go out and rush out and say, oh, this is a time to buy, and or, oh, shoot, a company that we owned is down 10%. We don't want to be holding it as it goes down another 20. Let's go. Rather, you go and look at your discounted cash flow model and say, okay, what happens when tariffs are higher on this company? Well, how does that actually impact the revenue growth rate? And even with tariffs, you actually have to think through, because the tariff is not on the selling price of the company, which is the revenue of the company. The tariffs is on the bill of materials, which is a component of the cost of goods sold. And so for every company, it's actually a custom calculation for how much tariffs actually impact them. And so when you've sat down and done that work for an hour or 2 hours, you're like, oh, okay, actually, it's not that bad. And the markets maybe are actually overreacting. And the other part of the process, I think, that really helps us here at Moeller is our inventory ranking system. And then more recently, the inventory alert system that we've built out. So in our M42 database, we have probably a couple of thousand companies now that are ranked in inventory. And with our new inventory alert system, several hundred of those have specific alerts set up that are more kind of standard deviation based on kind of earnings ratios or kind of standard deviation of a price, but against a set or basket of companies. And so the several hundred alerts I alluded to, I'm talking right now specifically about US, because I'm actually not sure exactly how many alerts my colleagues have set up. But these are what are the companies that we think are higher potential. And so it was kind of funny, because last year, to be fair, a little up halfway through last year, but last year I got maybe all of 10 alerts in US midcap. And through Q1, I had 40 alerts on companies that we think are pretty attractive. And so now it's time for the process to shine. It's time for the thinking slow brain to kind of sift through each of these companies one by one and decide, well, how many of them in today's context do still make sense and are attractive, and ultimately, can they be more attractive than something in our portfolios currently? And that's what we always do, day in and day out, whether tariffs are 0 or tariffs are 125%. And we are, be boring and make money. And that's what we stand for, both before and after these tariff wars.
Well, it's a great spot to end the conversation. I appreciate the analogy. That's a good one. And definitely the having the processes in place ahead of time to be able to take in all of that information and to make it actionable. Really appreciate your time, Crista and Jeff. Thanks very much for joining.